Good morning from Singapore. Welcome to the press conference for the launch of AMRO's ASEAN+3 Financial Stability Report 2024 or AFSR 2024. I'm Lin Tan from AMRO's communications team, and I will be moderating today's press conference. Here with me today are Dr. Khor, Chief Economist at AMRO, Dr. Kevin Cheng, Group Head and Lead Economist at AMRO, and Mr. Prashant Pande, Senior Financial Specialist at AMRO. In a short while, Kevin will share key findings from the report, and after that, we will take questions, starting with those we have received in advance. For the media in the room, please raise your hand if you have a question, and we will pass you the microphone. For those attending virtually, you may submit your questions in the meeting group chat throughout this session. Please note that this press conference will be recorded. Before we begin, we would like to remind you to mute your mics during the presentation. I now invite Kevin to take us through the AFSR 2024 highlights. Kevin, please.
Okay, thank you, Lin, and good morning, everyone. Welcome to this AFSR launch press conference. Today, I'll be sharing key takeaways from the 2024 edition of the AFSR entitled Strengthening Resilience to Challenges Ahead. I'll begin by first outlining the current state of financial stability globally and also in the region, followed by a discussion of the key risks that we face. I will then conclude with some policy recommendations aimed at enhancing resilience in the face of these challenges. So let's begin. Let's start with the global context. Since the launch of the inaugural AFSR in December last year, global financial conditions have gone up and down, and markets have navigating the bifurcated risk of a U.S. economic hard landing versus an inflation resurgence. As shown on the left-hand side, easing began since the fourth quarter of last year after major central banks signaled the end of tightening cycle, and their financial condition fluctuated throughout the year due to concerns about geopolitical tension, potential AI bubble bursting, and fear of inflation. Beginning in late July and early August, conditions tightened significantly as risks surrounding the U.S. growth outlook emerged, together with the unwinding of the yen carry trades. Most recently, around mid-August, markets have stabilized after the Federal Reserve sent a clear signal of easing and later cut the interest rate by 50 basis points. However, the sell-off served as a reminder about the fragility of market strength and the vulnerability to the risk of a U.S. growth slowdown. As shown in the right-hand side, we see that while not in the headlines, the stress in corporate real estate, or the CRE, partly reflecting a structural shift toward remote work and e-commerce following the pandemic, has intensified in the U.S. and other major developed markets. This poses risk for banks with large exposure to CRE, particularly regional banks. Indeed, over the past few months, some banks have reported losses on their CRE exposures, adding to concerns of financial distress. Now, turning to ASEAN+3 region. Regional markets generally follow global trends, but were also sensitive to domestic factors. Spillovers from the U.S. equity markets to regional equities were limited to only a few sectors. Regional market stress indexes show that during the first half of 2024, the stress in +3 economies has reduced relative to last year, while those for ASEAN has inched up but remain lower than the average market stress observed since 2010. However, market stress rose significantly, especially in Japan and Korea during early August. Now, turning to portfolio flows. The picture for the region is rather mixed, as the region's asset valuations have been less attractive than elsewhere. Debt flows in most regional debt markets surged in November last year, but has lost momentum since then. This is due to the higher U.S. Treasury yields that make them more attractive for investors. This resulted in outflow from emerging debt markets in ASEAN+3. However, as we move closer to the Fed's policy easing, U.S. Treasury yields decline, making the valuation of assets within the region more attractive, and thus capital inflows. And this capital inflows could continue if volatility in the market remain low. Now, turning to monetary policies stances of the region. In the left-hand side, easing inflation pressure and resilient growth suggest regional central banks may not be in a hurry to deviate from their current monetary policy stances. Indeed, as we can see in the chart, inflation across most of the economies have eased this year relative to last year, and growth is also projected to be stronger this year than last year. On the right-hand side, because of that, we see that most ASEAN+3 central banks are on hold, waiting for the right condition to start easing. Indeed, some have already started easing, with notable exception of Japan, where the central bank recently raised the policy rate in July. Now, turning to debt. Debt to GDP ratios in many ASEAN+3 economies remain significantly higher than pre-pandemic. As shown in the left-hand side, in 2023, ASEAN+3's total debt to GDP ratio, including corporate, household, and government debt, increased by 10 percentage points relative to 2022, exceeding 290%. The rise was driven largely by corporate and government debt, while household debt also increased, but less rapidly. Although interest rates in some countries have started to decline, the overall debt burden will likely remain high due to increased debt levels. Now, on the right-hand side, vulnerability to high corporate debt continue to stem mainly from certain types of companies and certain sectors, including property and construction, manufacturing, and raw material sectors. Many unlisted companies, the smaller one, particularly micro and medium-sized enterprises, continue to face difficulties in servicing their debt. That being said, the larger one, the listed companies which receive most of the corporate debt, maintain very strong financial positions with strong interest coverage ratios. Now let's zoom in the property sector, which has received a lot of media attention in the past few years. The chart shows the financial health of property companies in the region. The big picture is that financial condition based on the metrics of profitability, liquidity, debt servicing ratio, capacity, refinancing risk, and leverage have significantly worsened in the past few years in the region compared with the pre-pandemic levels. Relative to other regions, ASEAN+3 countries have also experienced substantial decline in these indicators, particularly profitability and debt servicing capacity in +3 economies. Now, although ASEAN countries show less pronounced weaknesses than the +3 economies, they're also seeing trends of deterioration. Now, moving on to the next slide. And how do property developer vulnerabilities affect the banking sector? And on the left-hand side, we can see that the quality of property-related loans remains stable in ASEAN, but deteriorating in +3 since 2021. However, as shown in the right-hand side, we have conducted an in-house AMRO stress test, and the results indicate that the capital adequacy ratios would remain very sufficient under adverse conditions. Now, turning to the overall resilience of the financial sector. Despite stable credit quality and profitability, there are still pockets of vulnerability in the banking system. First, as shown in the left-hand side, overall, the NPLs remain very low in the region. But as suggested in the thematic chapter of the AFSL, the asset quality of bank loans in the property-related sector has deteriorated, especially in some +3 economies. On the right-hand side, meanwhile, we see that non-bank financial intermediaries, the NBFI sector in ASEAN+3 has continued to grow, in contrast to the declining share of NBFIs in total financing in other regions. That being said, the share of NBFIs in total financing within the region remains significantly smaller than the banking sector. Now, let's turn on to the risk. The first risk is the potential resurgence of inflation. As we can see in the left-hand side, the Fed has started cutting policy rates as the risk of inflation seems to have abated. That being said, while inflation has continued to ease, in 2024, the disinflation effort has proceeded at a pace slower than market expectation. Indeed, the final stretch of achieving disinflation has proved difficult, largely because service inflation has been persistent. Furthermore, there has been tangible risk of potential commodity price hikes that could be highly inflationary, and we'll discuss later in the next slide. Now, if U.S. inflation does not go down as expected or even research, Federal Reserve may need to raise rates again. This could affect the region through many channels, and one important one is the appreciation of US dollar after a Fed rate hike. As shown on the right-hand side, ASEAN+3 stock market are highly vulnerable to US dollar appreciation, and that is often associated with capital outflows. Specifically, the charts show that the US dollar appreciation could have significant impact on the region's stock market. Now, turning to the second risk, which is the rising geopolitical uncertainties. This could include the military conflicts in the Middle East as well as the upcoming US elections. Now, rising geopolitical uncertainties could impact financial stability through multiple channels. And one channel is that in the event of escalating Middle East tensions, commodity prices and shipping costs could sharply increase, and that could be highly inflationary. Higher tariffs and sanctions due to trade tensions could be also very inflationary and also recessionary, and can affect the investor sentiment very badly. Now, moving to the third risk, over the medium term, rising debt levels could lead to larger debt servicing obligation of both government and corporate. Although interest rates are expected to decline in the period ahead, it may not go down to the level seen in the last decade. A risk facing some economies in the region is the persistent increase in debt levels, combined with higher interest rate environment, which can pose challenges to government in the region. As shown on the left-hand side, government interest payment as a percentage of GDP are rising in many economies in the region. As we know, a fiscal debt overhang may create substantial doubt about the government's capacity to repay its debt, thereby undermining financial stability by eroding investor confidence, leading to higher risk premiums on sovereign debt and increase the volatility of financial markets. And that could be a negative feedback loop there. On the right-hand side, on corporate debt burdens, one particularly vulnerable segment is the lending to property developers, which can encounter funding shocks for a variety of reasons. According to AMRO's simulation result, we find that a 200 basis point increase in funding costs could push the share of debt at risk in ASEAN+3 property firms from 29.5% at end 2023 to 36.9%. Fortunately, however, if we take into consideration of the debt, take into consideration of their cash buffers, the proportion of debt at risk would be reduced almost by half. Now let's turn to the next risk, the fourth risk. While not an immediate concern right now, over the medium to long term, some of the important risks created by the US dollar supply chain could be haunting us, and they could be the maturity and currency mismatches. As illustrated in the table in the slide, most players have differing preference with respect to maturity of FX product they use. However, These activities do not offset each other, and often this risk could end up on the balance sheet of the financial system. In particular, the activities of the NBFIs, particularly those highly leveraged, are potentially risky as they are often unregulated and may be engaged in opaque transactions with hidden leverage and masked liquidity mismatches. Finally, in the US dollar supply chain, banks typically manage the residual risk of the system. The risk can be difficult to manage in adverse market conditions because the currency and maturity mismatches can magnify vulnerabilities under stress periods when risk aversion is very high. Now turning to policy implications. To minimize the risk related to inflation resurgence, central banks must remain vigilant regarding the upside risk to inflation. Also, for some economies, monetary, prudential, and other authorities may need to collaborate to maintain price stability by both monetary and non-monetary measures. To deal with increasing debt, central banks and prudential regulators must monitor financial imbalances and rebuild policy buffers and prevent a buildup of risk through macro-prudential tools. To mitigate risk from geopolitical tensions, authorities must enhance the resilience of the macro-financial system, and if there is any spillovers from worsening external environment, they must swiftly facilitate orderly market adjustment to external shocks. In the long run, authorities must foster an environment to address the financial stability issues arising from the mispricing of climate risk in the financial markets. Finally, the authority must also continue to keep pace with technological developments and safeguard financial stability while harnessing the benefit of digitalization. Last but not least, in this report, we have 3 thematic studies: the US dollar over-reliance, spillovers, and property developer lending. And all these studies all have the following, have some key takeaways as follows. To address US dollar over-reliance, it's important to build economic resilience through regional safety net, and also to encourage local currency usage. Beyond traditional diversification method, the region should also explore technological advances to facilitate cross-border payments and transactions in the local currencies. To safeguard the region's financial stability against spillover from other regions, we need to have a robust regional ASEAN+3 centric surveillance and collaboration by sharing data and enhance cross-border surveillance. In particular, it's important to monitor macro financial shocks from the global market. To reduce vulnerabilities arising from the property developers, it's important to enhance the soundness of financial sector that are heavily exposed to the property market. It's also important to improve market practice and conduct within the property sector. Last but not least, it's important to ensure that financially stable property companies do not default due to credit shortages caused by adverse market reaction. This can be achieved by improving access for credit for sound firms, providing guarantee for viable projects, and easing debt burdens through measures such as extending bond maturities. And thank you very much. This concludes my presentation.
Thank you, Kevin, for your presentation. Now we will start to take your questions. As mentioned, those media who are with us in the room can raise their hand, and those online can type them in the meeting group chat box. Please identify yourself and your organization before asking your questions. We have received a few questions in advance. The first 2 questions are on the Federal Reserve's recent rate cut and its impact on the ASEAN+3 region. The first question is for Dr. Khor. Do you expect regional economies to enter a monetary policy easing cycle following the Fed's rate cut?
Thank you, Lin. Thanks for the question. Indeed, I think some central banks in the region, they've been waiting for the Fed to move first. And the Fed has moved, but the reason they've been waiting on hold is not because they need to cut the interest rate. It's primarily because the US interest rate is very high, and there's a carry trade that's putting downward pressure on the regional exchange rate. So, as Kevin pointed out in his presentation, exchange rate were under pressure until recently. And because of that, many central banks were, even though they were moving together, were not comfortable with that. And we know that, for instance, Bank Indonesia actually raised the interest rate in order to support the exchange rate, and recently has reduced the interest rate again. So the cut in the Fed interest rate is important because it provides more room or flexibility for the central bank in the region to adjust the exchange rate. But the adjustment of the exchange rate will depend on country-specific conditions. It's not clear that everybody's going to be cutting interest rate going forward. Japan has raised its interest rate, as we know, in July, because they're trying to cap inflation from going above 2%. And other countries in the region, for instance, PBOC has cut its interest rate even earlier, and recently it's cut the interest rate again in order to support domestic demand and also the property market. Similarly, BSP has cut its rate, and they cut it even before the Fed cut its rate, right? And the governor has indicated that there's scope for further cuts if necessary, and similarly for, I think, Bank Indonesia. So the situation varies from country to country, and Malaysia and Bank of Thailand, on the other hand, have been on hold, and there's indication that they will continue to hold because they're comfortable with the inflation in the economy, which is quite low in both countries. And at the same time, the economy is growing robustly, so there's really no reason to cut interest rate at this point in time for those two economies. So, as I said, the Fed easing of interest rate is important because it provides greater flexibility for the central banks to move.
Thanks, Dr. Khor. The second question is from eThai Media. How do you anticipate the Federal Reserve's rate cuts will impact the Asian financial markets? Kevin, would you like to take this question?
Okay, thank you. So the impact of the Federal Reserve cut on the ASEAN+3 financial market would largely depend on the drivers behind the Fed cut. Now, so far, the September rate cut has been very positive for the EM asset valuation in the region, including equities, bonds, and currencies. Specifically, the exchange rate in the region have appreciated against the US dollar, and with capital inflows and easier financial conditions, etc. Now, looking ahead, the effect of further rate cut would depend on why the Federal Reserve would need to cut further. Now, if the reason is like the August, where the inflation has disinflation effort has been very successful, and the labor market, they just want to stimulate and preserve the robust labor market, then the effect will be very positive for the region. We should continue to see stronger equities prices, bond prices, and stronger currencies, and you can see capital inflows and easier financial conditions. However, if the rate cut is due to a hard landing of the US economy, then it will be a risk-off a moment. There could be capital outflows from the system. US dollar would strengthen, the currencies in the region would weaken, equity prices and bond prices will fall, there would be some increase risk aversion, and that also feed back to the macroeconomics as well, and that could further depress the prices and have a negative feedback loop going forward. So to sum up, the factors will really depend on why the Federal Reserve need to cut further.
Thanks, Kevin. Up next is a question on the US economy. Do you see a recession coming in the US, and if yes, will that cause a major market correction, and how does it affect the ASEAN+3 region? What do you think, Prashant?
Sure. Thanks, Lynn, for the question. So AMRO per se doesn't forecast US growth. but based on what we have seen as the consensus economics surveys, the base case is probably not for a US recession. That said, if at all the situation materializes, it can have spillover impacts on the region. Most notably, as Kevin pointed out, it can lead to weaker equities. Exchange rates may have some sort of mixed reaction initially because over the past 2 years you have a lot of interest rate differential story driving the interest rates. There can be some appreciation, but as the risk of sentiment gains more momentum, dollar will strengthen and the regional currencies would weaken. On the bond markets, it can be a very economy specific reaction because there are a few bond markets where which are more sensitive to the risk backdrop and the yields could rise there, whereas some others where the central banks are expected to move in reaction to the US Fed, the bond yields will come down. Overall, this will be an environment when volatility will be high in the financial markets. There will be capital outflows from the region and there will be more pressure on the currencies as well as the equity markets. So yeah, that's broadly the spillover, and as Kevin mentioned, there can be some feedback loop into through the real side of things into most of the regional economies. Yep, thank you.
Thanks, Prashant. The next question is on the property sector in ASEAN+3. What are the primary vulnerabilities in the property developer sector across the ASEAN+3 region, and how do they differ between countries? Kevin, would you like to respond to this question?
Yes, thank you very much, Lin. In fact, we have a very detailed study, a thematic chapter 2 in the AFSR. You can see all the detail there. But the highlight of the chapter is that the property market downturn combined with a tighter post-pandemic financial environments has increased the risk for developer across ASEAN+3. But the major one that have the problem facing problems is the ASEAN+3 developers because they are seeing declining prices and transaction volumes, and also there's like a very, very bad investor and consumer sentiment there. And because of that, they are facing some difficulty with refinancing risk, particularly those developers who are highly leveraged. And there are also a lot of bonds that would mature by 2025, and a lot of them are not highly weighted. Now, for ASEAN economies, they perform better than the +3, but they still face a deteriorating trend, of course, but they are not as severe as the +3 economies. Now, we can also see some rising non-performing loans in the property sector. But however, fortunately, the bank exposures to the developer overall systemically is not very large, including the +3 economies. However, in some economy, particularly China, we see that there's like some regional banks, some smaller local banks can be exposed to the property sector. And this is something that the regulators and the central banks need to pay close attention and requiring close monitoring and surveillance.
Thanks, Kevin. The next question is for Prashant. What is your view on the US dollar and regional currencies going forward with the Fed's rate cut in September?
Thanks, Lynn. So going forward, again, interest rate differentials will probably be the most important drivers when it comes to broad US dollar and EM currency trajectories. So because Fed is expected to ease rates further, it's very difficult to expect very strong dollar going forward. Of course, there are caveats, which I'll come back in a bit. But if you look at the regional currencies, there is very little reason for the regional currencies to weaken further, given that the macro backdrop remains the same. The other aspect to look at it is what is the current pricing of Fed rate cuts. As of now, there are 50 basis point more of rate cut expected in 2024 and around 100 basis points of cut in 2025. For the dollar to fall further, depreciate further, we need more dovish expectations of the Fed. So as long as these expectations hold, there is very little room for US dollar to weaken, as well as there is very little reason for US dollar to strengthen. Now let's come back to the caveats. The first is the geopolitical tensions. As we have seen in the past few sessions, there has been increased geopolitical noise, and that has led to some strength in US dollar. So whenever the risk aversion will rise in the markets, which can be because of geopolitics, which can be because of US growth shocks, these are the scenarios where US dollar can strengthen a lot. On the other hand, if disinflation in the global economy continues, maybe it also picks pace, and the Fed is expected to cut because of inflationary, rather disinflation going forward at a higher pace. I think that's something which will lead to the dollar falling further, and the regional economies will benefit from that perspective. Another thing to watch is the commodity prices. Those are something which can create some sort of differentiation between regional economies. A lot of the commodity exporters in the region can do well if commodity prices rise, whereas if commodity prices are weak due to various reasons, these currencies can actually depreciate. Yeah, those are the factors that we'll look at going forward.
Thanks, Prashant. Up next is a question for Dr. Khor. How do you think the recent stimulus measures announced by China will impact growth in China and the broader region? After the recent easing by PBOC, how do you see the impact on China and Hong Kong as well as the region? The stock markets in China and Hong Kong have rebounded. Why? Do you see a turning point?
Thank you, Lin. Yeah, indeed, I think the latest set of measures by PBOC was pretty broad and comprehensive. But it's a series of measures taken by the authorities, starting last year. And May, they, for instance, cut interest rates and try to support the housing market. And then in July, after the third plenum, they announced a set of policies, but those are more structural, directed at the structural issues in the economy. So the latest set of measures by PBOC should be seen in the context of the evolving economy. And it definitely is quite positive. The market has reacted very positively, although there's been some retreat last few days. So I think as policymakers, they are trying their best to support the economy, stimulate demand, and help the property sector recover. And each time, it depends on what happens after the measures have been announced, implemented. So it looks like market is very confident. Initially when they were first announced that this would help to revive the economy. Although more recently, there's been some pullback. And now we know that the Ministry of Finance is going to come out this Saturday to announce some measures. Again, we don't know how big the measures are going to be. But I think one thing is certain, and they are not going to announce a big, huge stimulus package as they did back in 2009, which was like 25% of GDP, and it led to huge over leverage and a lot of excess capacity. This would be a lot more measured, but it could be bigger than the market expected. And if that's the case, they would help to revive the economy, stimulate domestic demand. What is important is the property sector, which is undergoing a major correction. Initially, our view was that the correction will be turned around, the market will turn around by the end of the year and maybe early next year. But we did a study after that, and it looks like the market is still in a recession phase, and will only turn around middle of next year. But with this new set of stimulus package, we think that the property market will turn around much sooner. And if that happens, it will have a big impact on the economy, as we know, both because the demand for durables will be increased, land prices will go up, and that will help also the local governments as well. So this is a very important set of measures that have been announced, and it's going to help the economy recover.
Thanks, Dr. Khor. Now we turn to the live questions. We have a question from Kiri Post, and this is for Dr. Khor. Cambodia is battling high NPL rates with credit growth at its slowest pace. while the Fed has started reducing interest rates, do you expect credit growth to improve in the near term? What is the impact or risk on the banking sector if the current conditions of NPL and credit growth persist? How can the central bank remedy the situation?
Yeah, Cambodia is also going through a real estate correction. So it's not just China, but some of the countries in the region, Cambodia and Vietnam in particular. And so what we've seen, we were there quite recently, that the NPL has actually spiked up quite a bit. On the other hand, the bank's capital adequacy ratio is very high. They have very strong capital buffer, very strong liquidity ratio. So the banks are not at risk at all. But what has happened in the past year is that because of the very high interest rate, there's been a slowdown in credit growth. And that is beginning to turn around. So we think that the authorities are doing whatever they can to also help the real estate sector turn around. There are some regulatory structural issues in the case of Cambodia, which they are trying to address by passing some legislation, for instance, property rights and that kind of issues, or collateral rights of collateral. So we feel that the economy is very robust. It's growing at 5.4%, and next year we think it's going to grow by 5.9%. It's beginning to recover. It's been dragged now because of the pandemic and because of what's the drag from the property sector.
Thank you, Dr. Khor. We still have another question from Kiwi Post, and Dr. Khor, this is directed to you again. Assuming the Fed monetary easing continues, do you foresee recovery in the real estate sector and an improvement in loan asset quality? The Cambodian Central Bank has flagged a sharp rise in real estate NPL since last year.
Yeah, I already commented on that, which is that the NPL ratio did spike up very sharply, and we were concerned about that. But at the same time, the spillover onto the bank is quite small because banks have very strong buffers, as I indicated. And we know Cambodia is a 90% dollarized. It's a very open economy. There's no control on capital flows, and so investors are still very confident about Cambodia. And if you look at FDI flows, they are very strong coming in. And at the same time, their export sector has recovered. Garment sector and in previous years, the solar panel export was also very strong. So the economy has actually turned around remarkably well from the shock of the pandemic.
Thank you. Up next is a question on Singapore, and this is from Zhao Bao. Dr. Khor, what's your view on Singapore? What are the key opportunities and risks?
Singapore, I think the latest numbers show that the economy is doing stronger than expected. Singapore is one of the most open economies in terms of export, and they were hit very badly last year because of the downturn in manufacturing export. But that has turned around. We know that electronic cycle is on the upturn, boosted to some extent by the AI industry. So that has helped to lift the economy. And at the same time, inflation has come off the peak and actually is much weaker than we expected now. So I think that has provided the monetary authority with room, to ease policy somewhat. Because if you look at the Singapore exchange rate, actually is very strong, as we all know. But Singapore is also working closely with Malaysia now to try to get more synergy out of the two countries. So the special economic zone in Johor is a very good example.
Thank you, Dr. Khor.
Maybe I want to add something.
Please go ahead.
So Singapore has been actually doing very well, as Dr. Khor mentioned. Now, in terms of the financial stability, is also doing very well because the banks have very strong balance sheet, very strong capital ratio, liquidities, and there's no debt, but then the major risk going forward would be, as Dr. Khor said, it would be because a small open economy is highly vulnerable to external shocks. And one particular one would be, going forward, would be the geopolitical. Particularly when there's like a military conflict that could increase the commodity prices and inflation. And also, Singapore is somehow in the middle of a geopolitical tension. So if like in the next U.S. election, if it's more protectionist measures that could also affect. Now, in the long term, what Singapore needs to do is that to manage the risk arising from the aging population. Singapore is one of the economy with the most age in the region, and also need to deal with climate change, and also Singapore need to remain relevant, and also need to maintain its comparative advantage going forward, because it's still a small open economy.
Thank you, Kevin. The next question is still for Kevin. What are the risks to the region's financial stability from the outcome of US elections?
Okay, so we don't have the crystal ball. We cannot predict the outcome of the election. So with the victory of the Democrat, the Harris victory, there'll be more predictability, because chances are she's going to likely to maintain the current monetary fiscal policy. So there will be some gradual easing of the monetary policy, and maybe she may maintain Biden's fiscal policy, although there may be some small changes. There may be more taxes for the big corporation and for the wealthier, etc. Now, for Trump victory, there could be more uncertainty and more unpredictability, because there could be gap between what he promised in the campaign versus what he would actually deliver. Now, assuming that he's going to stick with his campaign promises, then we will see that there would be higher interest rate, there will be higher deficit because of a major tax cut. And we're going to see a stronger US dollar. And also he's going to maintain, if he's going to keep his promise of trade war, then there will be a higher tariff, which will be inflationary for the USA, but also could strengthen the US dollar, but weaken the local currency here. They'll create a lot of uncertainties and volatility in the market. But that being said, he may not necessarily keep his promise. The actual implementation, based on the actual scenario, he may deviate from his rhetoric. So in some, there'll be more uncertainty and less predictability in the case of a Trump victory.
So we have run actually the policy measures announced by both Trump and Harris through our model. And there are many estimations of what the impact of the policy might be on the economy. And it shows that for the region, growth could be slashed by as much as 1 percentage point, which will be actually the most severe downturn in years. At the same time, I think the PIIE, the Peterson Institute, they have also done their own study. And it shows that the debt is going to escalate under Trump presidency, right? And that is going to put pressure on inflation, interest rates, and also with the tariff cut, inflation will spike up immediately, and that may actually cause the economy to crash. So there's a lot of uncertainty on what will happen with the Trump, but certainly I think between the Trump and the Harris presidency, a Trump presidency would have a more consequential impact on the region.
Thank you. Up next is a question from eTime Media, and this question is for Dr. Khor. What key factors do you think will most influence Asia's trade and economy for the remainder of the year?
Oh, there are many risks ahead. The most important one is the election that's coming up in a few weeks. So depending on who wins the election, that will have implications for the region next year for sure. But like Kevin mentioned earlier, there are also other risks, geopolitical risks, which is not the tension between US and China, for instance, and also the geopolitics in the Middle East that can escalate and lead to high commodity prices. So these are some of the uncertainties facing the region, and in the case of the tension between the US and China, I think so far, the region has managed that quite well. They have managed to position themselves as a connector between China and the US. And as a result, they've been able to attract a lot of investment into the region, because of the China Plus One strategy adopted by many multinational companies, both Chinese and US European companies. For instance, Malaysia is a good example where they attracted a lot of electronic factories into Malaysia, and also into Johor and the Klang Valley. So some of these, can actually have a positive side effect on the region. Not all of them are negative. Certainly, there's and this is the problem for many policymakers, because it depends on who wins the election. It depends on what happens in the Middle East. It depends on, how bad this tension between US and China becomes. Yeah.
Thank you. The next question is from Business World, and it's for Dr. Khor. How is the Philippines vulnerable to global spillovers and shocks from advanced economies? How can it stay resilient despite this?
On the Philippines, Philippines is a very different economy from the other ASEAN in the sense that it's a very service-driven economy. But it has been very resilient in the last few years after the big shock in 2020. It's been growing at about 5.5%, 6.5%. And it's continuing to grow very strongly, and it's attracting a lot of investment more recently, including in the electronic sector. It has the potential actually because it has the solar panel and wind power energy, renewable energy as well. And at the same time, the BPO industry is still doing very well. And on tourism, I think the economy is probably not fully maximizing its potential as a tourist destination, and there's a lot more potential for. But to do that, they need to develop the infrastructure. Infrastructure is one of the weaknesses in the economy. The policymakers are aware of that, and they have a very ambitious infrastructure plan. And with that, I think the Philippine economy will be able to grow quite rapidly.
Thanks, Dr. Khor. The next question is for Kevin. What spillover scenarios should policymakers anticipate, mitigate, and prepare responses for when risks materialize? What policy measures can be adopted by authorities?
Okay, so the ASEAN Pacific, we actually also have a features analysis of AFSR spillover, and then there's a lot of very exciting, interesting studies there. But let me highlight some of the interesting thing and also respond to this question. ASEAN Pacific is highly interconnected with the rest of the world. And so in terms of spillover, we can see three channels that could affect the region. One is through the banking sector shocks, particularly shocks from the United States and UK and Europe. And one shock that is already mentioned in the presentation is the CRE, the commercial real estate. We know that a lot of regional banks are highly exposed to CRE because of the change in the work from home environment. The commercial real estate are suffering in the West. And some regional banks, and then we have seen like last year in the Silicon Valley banks and others, they have fallen because of those exposure. And then we see that a lot of them continue to be highly exposed to them. So this could have been a spillover to ASEAN Pacific. And then the other one is the US dollar. And by the way, we also have an interesting chapter on the US dollar over-reliance as well. And as we can see is that the region is highly reliant on the US dollar. So a US dollar appreciation could affect the asset valuations and risk sentiment in the regions, and that can be a channel through which you can affect the region. And then last but not least, the commodity and energy shocks. And the region, many economies are exporting, importing like a commodity and energy. And then when you have, so suppose we have a geopolitical tension that could affect commodity prices, and that could affect inflation, supply chain, and that can certainly affect financial stability in the region. And also, they also, the cycle of the manufacturing cycle. Some of the regions are also depending on the semiconductor cycle, like AIs and Korea, Singapore, etc. So that can also be another channel. So in terms of policy, it's important that the region need to have stronger cross-border collaboration. This including enhancing data sharing, conducting regional stress tests, strengthening home host supervision, and ensuring liquidity support mechanism in place. And also, last but not least, it's very important to have continuous monitoring of global financial market and volatility, and particularly to have a strong and close surveillance on the globally systemic important financial institutions. And they need to stay ahead of the curve, and with that, they can protect or at least mitigate the spillover risks from the rest of the world.
Thank you, Kevin. The next question is from Malaya, and this is for Dr. Khor. Can I get your view about the recent effort to deleverage the global supply chain away from a China-centered process, and how does this change the dynamics of trade and financial flows in the region under the current environment?
Deleverage the global supply chain. Well, that's been going on for some time, but it sort of escalated with the pandemic because I think the pandemic made everybody realize that you need to diversify in order to build resilience into the system. And then it got exacerbated again because of the Trump policy. But as I mentioned earlier, the global supply chain is reconfiguring. We don't think it's going to split up because I think the whole global trading system is just too big and too efficient for anyone to isolate itself from the system. But it's reconfiguring, and the region is benefiting from this reconfiguration. So as long as I think the region stays united and open, to and continue to trade with all the other partners, I think the global trading system will be able to intermediate the friction between the two major power. So we are hopeful that the current trend will continue, which actually will benefit some of the countries in the region.
Thank you, Dr. Khor. Before we go to our last question, we would like to invite questions from the floor. Is there any question? All right. We'll just go to our last question. And our last question is for Prashant. What spillovers to ASEAN+3 are expected following the BOJ's rate hiking cycle?
Sure. Thank you, Lynn. So BOJ recently exited their negative interest rates, and they also increased it to 0.25%. This has been a shift which has happened after many years, and Japan has seen an era of low interest rates for a very long time. What that has done over the past few decades is that a lot of Japanese investors have actually moved out of Japan to look for higher yields. They have invested a lot in developed as well as EM markets, which includes a lot of the ASEAN economies. So once the interest rates start rising and the JGB yields and the other interest rates in the economy become more attractive, some of this capital may actually be reallocated to Japanese assets. So that's one risk, that there can be some amount of capital outflows from, say, many of the ASEAN economies and also some other EM markets around the world. The second important thing will be the business of the banking sector. Because of low returns domestically, a lot of the Japanese banks have actually expanded overseas. We don't see that this trend will reverse because of higher interest rates domestically, but there is a risk that the process will be slower than what we have seen in the past few years. So overall, it's not a major risk because eventually on the banking side, the business will still be slowly growing abroad, whereas on the portfolio investment side, the EM yields may still be better than Japanese yields. So on a volatility adjusted basis, a lot of the investors may still prefer investing abroad. So yeah, I think there will be some reallocation in the near term, but going forward, I think the markets will probably be able to digest the entire episode of BOJ rate hikes.
Thank you, Dr. Khor, Kevin, and Prashant for your insights today. Ladies and gentlemen, we have come to the end of today's press conference. Thanks for joining us. If we missed your question or if you require more details, please email us at media@amro-asia.org. You can visit the AMRO website to download the report, press release, and today's PowerPoint presentation. If you would like to give us feedback on today's press conference, please scan the QR code on the screen. Thank you and hope to see you soon.